Hello everyone, welcome to my channel. My name is Doraemon. Today, I'm bringing you a different kind of video, sharing some of my recent investment ideas and portfolio. For those of you who have discussed my crypto holdings in detail, you already know that my long-term crypto investment philosophy mainly focuses on holding major coins. When it comes to long-term value investing, if we don't choose a relatively stable market and instead turn spot holdings into leveraged trades, that actually goes against the whole idea of long-term investment. Let me take my current holdings as an example. Right now, I'm holding Ethereum, BNB, and so we all for a long-term holding. My cost basis for Ethereum is around $2,200, and its price is currently fluctuating around $3,500. For BNB, my entry price was $275, and now it's trading near $1,000. So my long-term investment philosophy is actually quite simple. Take Ethereum, for example. My conservative short-term target is around $5,000, which should be quite achievable. It's really about exchanging time for space, focusing on long-term holding. But of course, long-term holding requires patience. Entry points like $275 for BNB are almost impossible to find now. Bitcoin went from just a few $1,000s to tens of thousands in what felt like an instant. Catching those opportunities really tests your understanding of the market. So every time I talk about this topic, I can sense a bit of frustration from everyone. That's why people often ask, is there a project that's like long-term ETH holding can also generate stable annualized returns, something you can hold for the long term, and most importantly, doesn't rely heavily on perfect entry timing. So today's video is made specifically to answer that question. I'll share my research and testing results from the past year and a half, focusing on projects where timing isn't the key factor. We can explore and discuss this kind of model together. Before we dive in, I welcome all of you to join my Telegram discussion group. There I share the latest and hottest projects, and we also hold regular giveaways to thank all my followers. Most of the projects I share are time sensitive, so if you're interested in participating, make sure to join the Telegram group first and discuss it before investing. That way, you can avoid blind investments and unnecessary capital losses. All right, now let's take a look at what this project is really about. At its core, it's actually very simple. It's a multi-currency arbitrage hedging strategy in the foreign exchange for FX market. The assets being traded are currencies, the world's 8 major currencies that we're all familiar with. When you pair these 8 currencies 2 by 2, you get a total of 28 currency pairs. For example, EUR, USD, GBP, JPY, AUD, CAD, these are all common pairs. And the entire system operates based on these 28 combinations. So when we talk about multi-currency arbitrage hedging, it's all centered around these 28 pairs. It has 2 main components. One is hedging, and the other is arbitrage. Let me walk you through both. Let's start with hedging. Different currencies naturally have correlations. Some move in the same direction, some in opposite directions. For instance, EU and GBP often move together with a correlation as high as 80%, 90%. If you go long on one and short the other and size your positions properly, you can achieve natural risk hedging. Another example, when the stock market falls, gold usually rises. Holding both stocks and gold can serve as a form of risk buffering. Now let's talk about arbitrage. The FX market's volatility is actually very stable. Currencies don't experience the kind of wild swings you see in Bitcoin. They represent national economies, trade systems, and credit structures. For example, the normal spread between Euro and GBP might be around 800 pips. But if it suddenly widens to 2000 pips, we short the overvalued side and go long on the undervalued side. When the spread returns to normal, both positions make a profit. This type of arbitrage isn't about exploiting loopholes, it's about capturing recurring patterns in currency movements. The cycles are longer, but the win rate and stability are much higher. So why choose the currency market? Because it's both massive and stable. The global FX market trades around $10 trillion per day, which means single direction crashes or surges are nearly impossible. This inherent stability gives us a naturally safe operating environment. Next, let's talk about the quantitative trading logic behind it. Unlike strategies that trade a single crypto or asset, the multi-currency model spreads risk across 28 different pairs. Each pair holds only a small position, and many pairs even have natural hedging relationships. This means the overall position risk is very balanced. You won't see one-sided exposure or liquidation risk. The third key point is the profit to loss ratio. Take a $1,000 account, for example. The average monthly profit is around $500, $700, with a typical monthly drawdown of only $200, $300. Even in volatile market conditions, the model quickly recovers. That kind of profit consistency and recovery speed is what makes me confident in holding it for the long term. Now, about the annualized return model. The standard plan is based on $10,000, with each stop loss capped at $1,000, and the maximum risk controlled within 30%. Typically, there are only 1 to 3 stop losses per year. According to my backtesting results, the annualized return is around 84%, 100%. Even on the conservative assumptions, achieving 20%, 20% annualized returns is very realistic, which is excellent performance for large capital accounts. There are also different plans depending on capital size. For example, standard plan uses 1x leverage. Conservative plan uses 0.5x. Aggressive plan can go up to 10x. For me personally, my $20,000 account sits between standard and conservative, more on the stable side. So no matter your capital size or risk tolerance, there's a setup that fits your profile. Of course, your entry timing might affect short-term performance. Some traders see profit first and draw down. Others draw down first and profit. But over the long run, that really doesn't matter. Since this is designed as a long-term annualized model, there's no need to stress over short-term fluctuations. The key is execution and discipline. Just like buying gold or Ethereum for long-term holding, short-term price moves don't change your long-term conviction. To wrap up, this multi-currency arbitrage hedging strategy stands out for its sustainability, scalability, and unlimited capital capacity. It also completely removes the anxiety of missing the entry point. It allows investing to become more rational and systematic, achieving steady, long-term capital growth through multi-currency diversification, risk hedging, and stable annualized returns.